Ginkgo Bioworks Disappoints is the title of today's presentation. If you're somebody that's holding Ginkgo Bioworks stock or thinking about holding Ginkgo Bioworks stock because you see it trading at $1.25 a share, you will want to watch this presentation because we dig into some concerns that we have about the company. Now let's start by quantifying our disappointment. And in its most basic form, you can see on this slide here taken from their SPAC deck that the company made certain promises about Foundry, which is their now called cell engineering platform. That's the entire value proposition. I don't lie when I say that synthetic biology is probably the single most exciting theme we cover. Ginkgo Bioworks, consequently, is the best chance that you have at getting exposure to that theme, given the other two firms, Zymergen, which they acquired, which had failed miserably at what they attempted to do, and Amyris, which is in the business of selling cosmetics now, quite the pivot. Both those firms are obviously not viable ways to play synthetic biology, so Ginkgo Bioworks is very exciting. So when they promised investors $100 million in 2021 revenues for their Foundry platform, they beat that estimate. They brought in $113 million versus the $100 they promised. That's great. Last year, not so good. They promised $175 million in Foundry revenues. They brought in $144. And this year, in terms of what they're expecting to bring in for Foundry, well, that's going to be last year's goal, around $175 million. What's even more concerning here, and we're going to touch on this later, is that they're not receiving cash for the Foundry platform. The cash they're receiving is actually going down over time. Well, they're receiving some cash. You can see it here, $73 million in 2021 and just $68 million in 2022. The rest would be in equity. That's a concern. So we recently published a piece called Ginkgo Bioworks Beware of the Bait and Switch. Prior to that, we published a piece titled Ginkgo Bioworks Finally Time to Go Long. So you'll want to read both of those because they contain extensive detail about the bull and bear thesis. And in this presentation, we're just going to touch on some points. Now, when we talk about bait and switch, some of you, let's say half of you who hail from around the globe, may not be familiar with the car dealership model in the United States of America. I haven't bought a car abroad. I don't know if this exists in other places, but they use lots of clever tactics. For example, see the gentleman sitting in the white shirt in the lower left of this picture? That's a car salesman, and when he leaves that desk, if there's two people sitting there, they'll be recording those conversations when he goes back to quote-unquote speak with the manager. And if you're a couple talking about the points of contention for that car sale, they know exactly what those are, and they use that against you. Another tactic, and I'm not particularly sure if that's legal or illegal in certain states, but I can tell you the bait and switch is illegal. That's where they have a car parked outside the dealership at a very attractive price. People come in and then they direct those individuals away from that vehicle that was used as bait to vehicles that will provide the dealership with more revenues. Now, let's talk about a basic model of success for Ginkgo before we talk about the potential bait and switch that's happening with Ginkgo's business model. The idea, what we signed up for, is a client uses the magical SynBio platform to create new products. They sign up for these projects, what Ginkgo calls new program additions. The client then produces a product using the platform. Zymergen took a different approach. Zymergen decided they were going to produce their own products. Bad idea, and we pointed that out when they had their IPO. Zymergen actually didn't take the SPAC route. Good for them. Unfortunately, they failed to bring that product to market because, as we pointed out in our piece, they hadn't mastered the platform. They were actually using third parties to produce their products and all but admitted that. So getting back to Ginkgo, client produces product using Ginkgo's platform. Client then uses this new product to cannibalize existing products or address new opportunities. This is a success story that should result in downstream upside for Ginkgo. That's a very important point. Clients then can't believe how great SynBio is. They immediately add new projects to Ginkgo's pipeline, and Ginkgo goes about transforming the trillion-dollar manufacturing industry. Now, we've always envisioned Ginkgo as having a smaller set of large marquee name clients across each industry vertical. That makes it easier to manage than having a large set of smaller clients. It also gives you more upside because of economies of scale for downstream revenues. Let's talk about downstream revenues because those are indicative of successful products being developed on Ginkgo's platform. Here are 3 forms of downstream revenues that Ginkgo talks about. I want to draw your attention to the lower left. These bar charts here are not to scale, so you'll need to pay attention to the numbers. For example, royalties, you can see they're less than $1 million, very insignificant, actually declining in 2022. That's not good. Below that bar chart of royalties, you see what's called legacy product supply revenues. They define these as overseeing manufacturing of raw materials for certain customers at a contract manufacturing facility. Could that be Twist? Legacy model operates largely as pass-through with contract manufacturer. In other words, that has nothing to do with the value of Ginkgo's platform, and consequently, we don't care about those revenues. But look, they're increasing because that's a legacy offering. We have no idea why. The biggest concern, perhaps, when they talk about their downstream revenues and the growth, where that's coming from, milestones received from this cannabis firm called Chronos. And you can see here that they received some meaningful amount of money. It's the majority of their downstream value has been received from a particular customer, and it doesn't look that great. So when you look into what they were doing with Chronos Group, you find something that's rather disturbing. So in Chronos Group, one of their financial filings, we came across this point about impairment charges for the differences between the consideration paid to Ginkgo for the achievement of 2 equity milestones in connection with their collaboration agreement and the fair values of the exclusive licenses for these 2 CBD formulations that were developed on Ginkgo's platform. What were those used for? Well, one was used for the company's Spinach Feels Chill Bliss 2-in-1 THC CBG gummy. You can see here on the right. Now, do you think Joe cannabis user that goes into a dispensary is going to be looking around for a gummy bear that's significantly overpriced, that millions of dollars was spent developing this formulation with Ginkgo? The person doesn't know nor care about that fact, and it adds no value to a very commoditized and disparate industry where everybody and their brother now has a product out. So if this is the low-hanging fruit, we just question that right away. Why CBD? So we've covered CBD extensively. We've worked actually with one of the leading CBD firms in the United States, helping them sell their product. And it's quite funny. We researched this heavily. CBD isn't something you can feel any effect from. It just works over time, and you need to trust that. It's all very odd. Is Ginkgo's biggest success story so far a CBD gummy? Certainly seems like it. Is the economy or the economic value of creating CBD, this compound, the lowest hanging fruit on the tree of endless possibilities for Ginkgo's platform? One would hope not, because when you look at their SPAC deck, you can see that they have a number of verticals. On the far left here, look, consumer and tech. See, cannabinoids, those are the 2 compounds from Chronos Group, which we can see the amount of money paid versus the value that Chronos got was negative, which is why they had that impairment charge. And then we have fragrances, insect repellent, high-tech electronics are working with these other firms. Moving to the right, we see Cargill. That's a very big name, working with them on various bits. And then you can go all the way to the right and notice here there are some marquee names. Cargill, of course, Roche, and you have Moderna. Would love to see some downstream value realized from some of these bigger names. Now, when you look at what Ginkgo talks about, one of their slides in their recent investor deck, again, these pivots of focus, they say, we're finally opening up the biopharma market growth opportunity. Okay, you look down here in the lower left, you see I've highlighted 3 things. One is the legend there that says Ginkgo penetration. And look, they say for industrial biotech, we can only assume that these are to scale, that they have 50% penetration, implying that they have a great deal of penetration in that segment. Well, where are all the downstream revenues coming from that? Who knows, right? And you move to the right, they say, well, we're going to realize increased penetration on the biopharma segment, what they're calling this large opportunity in pharma. And that seems to be kind of pointing to the fact that now they're suddenly going to realize this potential in biopharma that they say specifically here, well, hard to forecast downstream value share is an important component of our model. For biopharma discovery programs, they tend to have a relatively high value potential and longer time to downstream value realization. Great, so now we're introducing new programs that are going to take even longer for the downstream value to be realized, not to mention none has really been realized except for Chronos Group. And then they mention here the inflection in our growth in biopharma is a key indicator of success. No, it's not. A key indicator of success is growth in Foundry revenues in your cell engineering platform. That's what we signed up for. So that's quite suspect. Then they make this remark here. 2023 marks the beginning of biosecurity as a recurring infrastructure service. So this is when they pivoted into the pandemic with this concentric anonymous testing, and now they're spelling this out as a biosecurity as a recurring infrastructure service. They mention these biosecurity-focused memoranda of understanding with partners in Qatar, Rwanda, Saudi, and the Republic of Botswana. Well, I've actually been to all these places, and I can tell you the Saudis and the Qataris are going to be open to whoever wants to come by and give them something, pay them a little attention, and they'll gladly sign whatever memorandum of understanding, the legal equivalent of a handshake, you shove in front of them. As for these other two firms, Rwanda and the Republic of Botswana, they have a lot bigger fish to fry. I always like this picture. This was taken from a flight I took in Rwanda, and this is not what you want to see in your in-flight travel magazine. It says the National Institute of Transportation starts to offer aircraft maintenance engineering courses. Great. So what were they doing before that? So these are not countries that have a lot of discretionary spending for Ginkgo to realize, and that this comment about these memorandums of understandings wouldn't be out of place for an over-the-counter company. So let's talk real quick about their acquisition of Zymergen. So they talk about how Zymergen team is expected to fill significant planned hiring by Ginkgo. So it seems to be an acqui-hire, fair enough. And then they talk about how there's potentially upside if they can monetize Zymergen's product pipeline or restructure real estate obligations. Doesn't sound very promising. Again, this is a comment we made back several years ago. We're talking about Zymergen. We said it smells a bit like another synthetic biology stock in Trexon, and we all know how bad that cookie crumbled. If Zymergen wasn't able to get their platform to work, they were having third parties manufacture their products, then that was a huge problem. And for them to IPO, that seems rather immature. Now, what's also interesting is when you read the investor presentation by Ginkgo, which talks about their acquisition of Zymergen, they also talk about this deal with Bayer, which they spun as a big deal. Well, they've been working with Bayer now for over 5 years. And I put up this press release here in the top left. Bayer and Ginkgo Bioworks unveiled joint venture Join Bio. Below that, you can see a list of all these startups that are generating recurring revenues, or say related party revenues for Ginkgo, which, by the way, are decreasing. That's the one thing I noticed that's great to see. So these related party revenues are decreasing. Perhaps, at least in the case of one, it's because it was dissolved. Join Bio, the oldest of the startups that Ginkgo spun off, has now been dissolved, and of course they spin this as a good thing. Whether or not it's good or bad remains to be seen, but Bayer received $83 million consideration from Ginkgo, and then Ginkgo is supposed to receive payments from Bayer over time. It's not very positive when you see a joint venture like that being dissolved, and of course Ginkgo will try to spin that as a positive, but we view that with, let's say, some deal of suspicion. Now, another thing that we need to consider here when looking at what Ginkgo is promising for 2023 is this notion of there being no estimate for downstream value. You can see here for the full year outlook, you see, well, cell engineering, they're going to bring in 175. That's great. Nice growth there. Never mind, that's the goal that you had last year. It's great that you're setting a goal like that and hopefully achieving it. And we see biosecurity, coming in at a third. That's fine. We're not here for the biosecurity revenues for Rwanda and Botswana and the Saudis. We're here for cell engineering. But look at downstream value there. See how that's not provided? That's a bit suspect. So was Chronos Group kind of all they had in their pocket, and now that that's exhausted because Chronos has clearly realized that wasn't working out for them, is that all that remains to be seen? Well, they tell us that approximately $2 billion in aggregate future cash revenue potential was added in 2022 last year, and they say, though, commercial milestones carry significant risk. Yeah, no doubt. More than half of those are attributed to this one company called Selecta Biosciences. Well, interestingly enough, we covered them late last year, and let's just hope they're not paying Ginkgo in shares, which they probably are. We'll talk about that in a second, because if they are, these shares are being very diluted over time. Selecta is a small firm, several $100 million market cap. And you can read this research piece we wrote, which talks about the company. But for Ginkgo to advertise them as some great accomplishment for all this future milestone revenue coming from a drug developer, it just doesn't sound very promising, especially when you look at this last table, which is very telling. Here you can see cell engineering revenue. So remember, we used to call it Foundry. Now we're calling it cell engineering, which is a much more appropriate name. Here you can see the related parties. Read this from right to left. So 2021 related parties, you see 47, 2022, 38. Great, so it's decreasing. Third-party revenue is increasing. Great to see. But look below that where we've circled this in dashed line. Non-cash consideration. Read from left to right. Cash consideration, let's say non-cash, goes from 40 to 76, so that's increasing significantly. But look at the line above that, cash consideration. That's cash they're receiving from their cell engineering platform. It's actually going down. So that's not a good thing. Now, just to conclude, we don't believe that Ginkgo has proven their platform is the magical SynBio solution we've all been waiting for. And you need to be very careful about this bait and switch where they move away from things that they were talking about, emphasizing promises that were made to new promises. So we're going to check back next year around this time to see what they've been able to accomplish. We're going to pay particular attention to downstream revenues, especially royalties. These are the ultimate proof of product market fit because they show that clients developed a product they could sell on Ginkgo's platform. And guess what? Look at the royalty structure on the right. They said industrial biotech, they have 50% penetration. Great. We should start seeing those royalties come in. So these would be low single digits and mid-single digits royalty rates. So we'll expect to see those start flowing, we would hope, in 2023, this year. And you'd also ask yourself, well, this Bayer agreement, they've been working with Bayer now for, 5 years? Why haven't we seen any royalties from that? So downstream revenues will be very important, not just coming from this cannabis firm, to prove that Ginkgo's platform has product market fit. I put up another video here on Ginkgo, the last one we did that you may want to watch, but before you watch that, please click the blue Nanalyze logo here on the right, subscribe to our channel. Thanks for taking the time to watch this today.